Welcome to Accounting for SS1 at LightTech Academy. Today we study depreciation, the reducing balance method. Recap: what is depreciation? Depreciation is the reduction in the value of a fixed asset over time. Last lesson we studied the straight line method where the same fixed amount is charged each year. Today we study the reducing balance method, also called the diminishing balance method or written down value method. The reducing balance method. Under this method, depreciation is calculated as a fixed percentage of the net book value, also called the written down value or carrying value, at the start of each year. Because the net book value falls each year, the depreciation charge also falls each year, hence the name reducing balance. Formula: depreciation for the year equals net book value at the beginning of the year x rate %. Net book value equals cost price, total accumulated depreciation to date. Worked example. A piece of equipment is purchased for 4 million Nigerian nairas. The reducing balance rate is 25% per annum. Year 1, depreciation equals 4 million Nigerian nairas x 25% equals 1 million Nigerian nairas. Net book value, end year 1, equals 4 million to 1 million Nigerian nairas equals 3 million Nigerian nairas. Year 2, depreciation equals 3 million Nigerian nairas x 25% equals 750,000 Nigerian nairas. Net book value, end year 2, equals 3 million to 750,000 Nigerian nairas equals 2,250,000 Nigerian nairas. Year 3, depreciation equals 2,250,000 Nigerian nairas x 25% equals 562,500 Nigerian nairas. Net book value, end year 3, equals 2,250,000 to 562,500 Nigerian nairas equals 1,687,500 Nigerian nairas. Year 4, depreciation equals 1,687,500 Nigerian nairas x 25% equals 421,875 Nigerian nairas. Net book value, end year 4, equals 1,687,500 to 421,875 Nigerian nairas equals 1,265,625 Nigerian nairas. Note: under the reducing balance method, the asset never reaches exactly zero, it asymptotically approaches zero. Accounting entries, same as straight line method. Debit, depreciation account, P&L, expense. Credit, provision for depreciation account, balance sheet, accumulated depreciation. Comparison, straight line versus reducing balance. Straight line method, same amount each year. Asset reaches zero at the end of useful life. Better for assets with even wear, e.g. furniture, leases. Simple to calculate. Reducing balance method, higher depreciation in early years, decreasing over time. Asset never reaches exactly zero. Better for assets that lose value quickly early, e.g. motor vehicles, computers, electronics. Matches maintenance pattern, early years have lower maintenance costs to offset the high depreciation, later years have lower depreciation but higher maintenance. Disposal of a fixed asset. When an asset is sold or scrapped, the difference between the proceeds and the net book value at the date of disposal is either a profit on disposal, proceeds exceed NBV, or a loss on disposal, NBV exceeds proceeds. Journal entries for disposal. Dr. Asset Disposal Account, with the cost of the asset. CR Fixed Asset Account, with the cost of the asset, removing it. Dr. Provision for Depreciation Account, with accumulated depreciation. CR Asset Disposal Account, with accumulated depreciation. Dr. Cash/Bank Account, with the proceeds of sale. CR Asset Disposal Account, with the proceeds. The balance on the asset disposal account equals profit, CR balance, credit to P&L, or loss, DR balance, debit to P&L. Remember this: under both methods, the asset account is never directly credited for depreciation. The credit goes to the provision for depreciation account. The asset account always shows the original cost. Remember, Reducing balance method / diminishing balance method / written down value method. Depreciation calculated as fixed percentage of net book value at the start of each year equals because net book value falls each year equals depreciation charge also falls each year. Formula: depreciation for year equals net book value at beginning of year X rate %, net book value equals cost price minus total accumulated depreciation to date. Example: equipment 4 million Nigerian nairas at 25% per year 1 equals Nigerian naira 4,000,000 x 25% equals Nigerian naira 1,000,000 / NBV 3 million Nigerian nairas, year 2 equals Nigerian naira 3,000,000 x 25% equals Nigerian naira 750,000 / NBV 2,250,000 Nigerian nairas, year 3 equals Nigerian naira 2,250,000 x 25% equals Nigerian naira 562,500 / NBV 1,687,500 Nigerian nairas, year 4 equals Nigerian naira 1,687,500 x 25% equals Nigerian naira 421,875 / NBV 1,265,625 Nigerian nairas. Asset never reaches exactly zero. Accounting entries: Dr. Depreciation account / P&L equals expense, CR provision for depreciation account / balance sheet. Comparison: straight line equals same amount each year equals reaches zero at end of useful life equals better for assets with even wear / furniture plus leases plus simple. Reducing balance equals higher depreciation in early years decreasing over time equals never reaches exactly zero equals better for assets losing value quickly early / motor vehicles plus computers plus electronics equals matches maintenance pattern / early equals low maintenance plus high depreciation, later equals low depreciation plus high maintenance. Disposal of fixed asset: difference between proceeds and net book value at disposal. Profit on disposal equals proceeds exceed NBV. Loss on disposal equals NBV exceeds proceeds. Journal entries: Dr. Asset Disposal Account / Cost, CR Fixed Asset Account / Cost, Dr. Provision for Depreciation / Accumulated, CR Asset Disposal Account / Accumulated, Dr. Cash Bank / Proceeds, CR Asset Disposal Account / Proceeds. Balance on Asset Disposal Account equals profit / CR balance or loss / DR balance. Important: asset account is never directly credited for depreciation. Credit goes to provision for depreciation account. Asset account always shows original cost. Thank you and keep excelling at Lightech Academy, powered by Lightech Solutions Limited.